Understanding what capital gains taxes are and ways to reduce them is one of the key ways to become a more educated and intelligent investor. But let's face it, capital gains taxes can be quite confusing, especially if you're new to investing. As part of our ongoing series on investing, we're going to be diving deep into the key things you need to know about capital gains taxes and strategies that the most savvy investors use to minimize them. Hey, if you're new to the channel, my name is Neil and I run Roundup Save with my wife Jenna. We're all about helping to demystify money so we can build wealth that lasts. If that sounds like something that's interesting to you, consider liking this video and subscribing to the channel so we can learn together. So with that, let's dive in. So what exactly are capital gains taxes? Well, they refer to profits made from selling an asset such as stocks, real estate, or even art for more than what you paid for it. And the difference between short-term and long-term capital gains lies in how long you've actually held the asset for before deciding to sell it. And the amount of tax that you pay, hence capital gains tax, depends on your income level and how long you held the asset for before selling it. So what are the differences between short-term capital gains and long-term capital gains? Well, short-term capital gains are profits made from selling an asset that you held for 1 year or less, and these gains are taxed at your ordinary income tax rate, which can be all the way as high as 37%, which really depends on your tax bracket. And the tax rates on short-term capital gains are typically higher than those on long-term capital gains. On the other hand, long-term capital gains are profits made from selling an asset that you held for more than 1 year. And the tax rate on long-term capital gains is generally going to be lower than that of short-term capital gains. And the rate that you pay, again, will really pretty much depend on your income level. So here's a side-by-side of short-term capital gains and long-term capital gains tax rates in 2023, split by filing status. Just look at the first row, for example, and you can see that the tax rate on long-term capital gains is 0% all the way up to $45,000, whereas you would be getting taxed immediately on short-term capital gains starting at a 10% tax rate. Okay, so here's some tips to reduce capital gains taxes. The first one is use tax-advantaged accounts. Okay, so now that we know the basics of capital gains taxes, we can start to think about some strategies to keep them low. One of the great ways to lower your capital gains taxes is actually to invest in tax-advantaged accounts like a 401k, an IRA, or an HSA, which stands for a health savings account. And by doing this, you can delay paying taxes on your investment earned until you retire, which really can help to reduce your tax bill and help you even save more in the long run. So for example, I didn't contribute to my HSA account at all last year because I thought I had specifically needed to have a health insurance plan with an HSA sponsored account. But then after I actually talked to my accountant, it turned out that my understanding of that was wrong, and if I maxed out my HSA and noted the contributions as being last year, that I wouldn't actually be owing any additional taxes, and instead I'd receive a really nice tax return. And so that was awesome to hear. That's because my taxable income went down, which actually lowered my actual tax rate. So instead of contributing the funds to my HSA pre-tax directly from my paycheck throughout the last year, I was essentially contributing to it after the fact and after having paid taxes already. So in short, this is what allowed me to qualify for the tax refund. Tax loss harvesting is a great investment strategy that can help you to reduce your tax liability. And by selling assets that have lost value to offset gains in other investments, you can avoid a steep tax bill. And it's pretty much like getting the best of both worlds. So with tax loss harvesting, it's important to follow the rules set by the IRS when trying this approach. And you can't just sell any stock that's lost value and expect to get the tax benefits. You need to carefully consider which investments to sell and when to sell. So there's definitely a lot more nuance involved with this approach. Also, keep in mind something called the wash sale rule. This rule doesn't actually allow you to buy a substantially identical stock within 30 days of selling a stock at a loss. By following the rules set by the IRS, you can effectively use tax loss harvesting as a tool to reduce your tax liability and improve your overall investment returns. If you'd like to see a good example of tax loss harvesting in action, I'll link an Investopedia article down below in the description and check it out. It's really helpful. Another great way to save on taxes is by donating appreciated assets, such as stocks or real estate, to a charity rather than selling them. And this strategy allows you to avoid paying capital gains taxes on the appreciation, which can be a substantial amount in some cases. Plus, you get to make a tax deduction for the donation's value, which can actually improve your tax bill in the long run. So it's important to note that donating appreciated assets, it can be complicated, and you may need to get the help of a financial advisor or a tax professional to make sure that you're actually doing it right. But it's important to make sure that you're also choosing a trustworthy charity that aligns with your values and your mission, as the IRS does have really strict rules for deducting charitable donations. If you're planning to sell an asset, it's also a good idea to think about the timing of that sale in order to minimize your tax liability. And one option to consider is waiting until a year when you expect to actually have lower income, which can help to reduce the amount of taxes that you're going to owe on the sale. And aside from the timing of the sale, there's also going to be other strategies that can help to minimize your tax liability. For instance, you might want to think about selling the asset in installments over time instead of all at once. And this can help to lower the amount of taxes you owe in a given year, and might also help you to avoid triggering certain tax thresholds that could lead to higher taxes. So all in all, capital gains taxes can be a significant expense for investors, but there are many ways to reduce them. And by using things like tax-advantaged accounts, harvesting tax losses, donating appreciated assets, and planning your sales, you can lower your tax liability and keep more of your investment gains. That's it, guys. Thanks so much for watching, and we'll see you in the next one.